Well, how is that decision going to affect the economy going forward? Well, Ken Goldstein, economist at the Conference Board, joins us live from New York to explore just that. Welcome to the show.
Thank you.
So what's your take on the pace of interest rate hikes, especially given the Fed's decision to add another one for 2018?
I'm not quite so sold that at the end of the year they're going to raise again. Whether they do it at the end of this year or whether that increase comes in February or March is really marginal. It depends on not so much how strong the economy is, and right now it's very strong. The question is, when does this strong economy lead to more inflation? We just got news just in the last 48 hours that the core CPI in the United States is rising at about a 2.2% rate. More importantly, there are nothing in the details in housing inflation, medical inflation, any of the other categories that inflation is really starting to move. So if in a very tight labor market, in a strong economy, we're not getting more inflation pressure, whether we get that increase at the end of this year or early next year is less important than when does that strong economy, when does that tight labor market start to put more upward pressure on inflation.
And certainly Fed Chair Powell certainly hinting that this isn't the time to celebrate what's happening with inflation. But what's been driving it so far, and what do you think is giving him the most pause when it comes to caution about inflation?
This is the big question, because the answer is we don't know why inflation isn't being driven higher by the strong economy, by the tight labor market. And so therefore, we keep saying, it's not just Chairman Powell, all economists are saying, inflation is going to heat up. We just don't know exactly when or by how much. If we could answer those questions, we could be crystal clear about not only how many, but when those increases in interest rates are going to come. Maybe one more point that's very important, you touched a little bit earlier in the show, and that is interest rates have gone from extremely low to low. So that borrowing cost, whether it's borrowing for business or you and I, paying for a car note, paying for a mortgage, they're still relatively low. And even if they do increase 2 more times this year, interest rates are still are going to be relatively low. So in terms of what the impact on the economy is, these interest rates are not high enough to really retard the strong economy. The strong economy will begin to moderate. Question is, by how much and by when? Certainly in terms of the Conference Board's leading economic index, it's probably not going to be this summer.
Right.
We could see a little moderation later in the year. And again, that combined with where inflation is going to determine more the timing than the number of interest rate increases.
Now, we've certainly seen a lot of central banks taking different approaches. So as they're looking at this, they're seeing borrowing becoming more expensive, and you're also seeing U.S. rates lure back more investors who had been looking for returns abroad. What does this combination mean for emerging markets and other central banks?
That's another big question, because those emerging markets, like in Argentina, like a Turkey, that have been heavily indebted and indebted in dollar-denominated debt, they're going to really feel this much more than the average American business, than the average American household. So the impact here is going to be stronger on some of the emerging markets than certainly in terms of the most of the domestic either business or consumers. And that's a consideration not so much about this increase, but the next one and possibly the one after that.
Now, the rate is also tied to consumer debt, particularly credit cards and also these home equity lines of credit. Who do you think is going to be most affected by this move?
It's not going to be on credit card debt. In fact, look, in this strong economy, with the kind of wage growth that we've had, at least to date, the fact that consumers are taking on a little more credit card debt, they're also bringing down the savings rate. These, in some sense, are signs of the confidence of consumers that it's okay right now to take on a little bit more debt. It's okay right now to put a little bit less in the piggy bank. And certainly that's consistent with what we're finding in terms of the Conference Board's Consumer Confidence Index.
Now, as we know, it's been a decade since the global financial crisis, and the U.S. economy has come a very long way since then. Any domestic or international headwinds, though, that we should be keeping an eye on?
Well, certainly, look, and the chairman of the Federal Reserve pointed this out in the Q&A after his announcement that the last two recessions have been more about bank instability and certainly the problems in the housing market than about either overloaded consumers and/or an inventory cycle. So, look, if you look at an economy whose trend rate of growth is about 2% and is now running faster than that, to start to worry right now, either for 2018 or all of 2019 about, is the next recession right around the corner? It probably isn't. And that's consistent with the findings of the Conference Board's leading economic index.
All right, thank you so much. Ken Goldstein there, economist at the Conference Board.